Okay, class, let's move now on to the income statement. Understanding, of course, that the income statement is the sum of all of your revenue less all of your expenses, which creates net income, and in turn that will flow up into retained earnings. So your income statement, most often you can look at single-step income statements or multi-step income statements. Your single step, which is not used very often by U.S. companies, groups all of your revenues together and then lists and deducts kind of expenses without any intermediate subtotals. Your multi-step income statement looks at one or more subtotals that may highlight some significant revenues, significant expenses, and the like. And that's what's most often used by U.S. companies, and that's what we're going to focus on for the purposes of this discussion. We talked a bit about kind of the flow of the multi-step income statement, which is often going to start with your revenues, and it's going to subtract from your revenues your cost of goods sold. So if you are the seller of furniture and you sell a desk, that of course is your revenue. The cost of goods sold of that desk may be the materials that are used to build the desk, the labor dollars associated with the people that built the desk. That's how the desk got into its sellable form. That would be your cost of goods sold. Your revenues less your cost of goods sold gives you your gross profit, also known as your gross margin. From there, you're going to deduct all of your operating expenses, which are most often referred to as your selling expenses, your general administrative expenses, your engineering expenses. I believe there's a couple folks in the class that are at biotech companies, so you're going to have our research and development expenses. Those are all costs, operating costs associated with doing your business. If you're in the accounting or finance department, you would be bucketed into your general administrative expenses. So your gross profit minus your operating expenses is going to give you your operating income. That's the income that your business has generated from its core operations. After your operating income, you're going to be followed by some of your non-operating expenses or your non-operating revenues. The best example there is you have cash in the bank, you have some interest revenue on your cash. That revenue is not core, is not a part of your operations, and so hence it is detailed out separately. Similarly, if you have debt and you have some interest expense on that debt, that interest expense is not one of the operating expenses of your business, and that would then fall below your operating income line. So your operating income minus all of your, or plus your non-operating revenues less your non-operating expenses minus your income taxes is going to give you your net income for the company. I'm going to pause for 1 second and shift over to another page where in fact I'm going to try to show you an income statement from a public company. Okay, so we're back, and this is the income statement for Apple. Of course, their revenue, these of course are in millions, but very, very big number. That is the total of all their iPods, all their iPads, all their Macintosh computers that they've sold. Then they have their cost of revenue, which is the cost associated with building and manufacturing all of that. That then yields their gross profit. Below that, they have their operating expenses. As Apple, you would guess, has a significant level of research and development expenses, creating the next big thing that they may be able to sell, or making significant enhancements to the next generation of the iPhone. And they also have their selling, general, and administrative expenses, which of course are all their sales people, it's all their accounting people. There may be some engineering in there, if engineering isn't otherwise in their research and development. And their gross profit of 70.5 less their, call that about 17 million or so of operating expenses, yields their operating income. They have a number of items that are down below. They've bucketed a number of here. There are other income and expenses, and that could be a litany of different things. But suffice it to say that given how much cash they have, a lot of that very well may be interest revenue. They also have issued bonds, or they have some debt, so that could be some interest expense in there as well. But obviously, it's a net positive number because their operating income plus that 980 yields their earnings before interest and taxes. And then they also have a fairly sizable income tax expense, which yields all the way down to their net income. Shifting back, we can move through this next section reasonably quickly. And we're going to talk about some of the ratios that exist to assess profitability. And profitability, of course, is the overall net income profitability of an organization, and hence the rate of return that you as a stockholder are able to obtain on owning one or more shares of their stock. And the income statement is a very powerful tool for you to be able to assess that profitability. 4 fundamental ratios to look at: your gross profit percentage. And again, if we look at Apple, your gross profit percentage would be, as the numerator, your gross profit, as the denominator, your total revenue. So in this case, if you divide 70.5 divided by 182.8, that's 38%. So effectively, for every dollar that they sell of something, 38% of that is their gross profit. The other way of saying that, approximately 62% of every sale is incorporated in their cost of building it. So let's move on. Gross profit percentage, as we just said, your gross profit divided by your sales. That's useful. This just says retailers or manufacturers and choosing a pricing strategy, but it's really useful for most any organization. I think there may be a couple of you that work at software companies. Software companies tend to have very, very high gross profit margins. But if you are, let's say, Apple, and you're looking at your own gross profit, you might be able to, in your organization, want to compare that to the gross profit of Samsung, to be able to say, okay, Samsung is also one of the leaders in the sale of mobile devices. If we have a 38% gross profit, and let's just say, for example, they had a 43% gross profit, each sale of an incremental device that Samsung sells is yielding a little bit more gross profit. What are they doing more efficiently or effectively that maybe we can think about? As a stockholder, that would be one of the measures or margins that you would look at to determine, is this organization well run? Are they creating good profits? Are the sales of their items very, very profitable? Return on sales ratio, which is your net income divided by your sales. So for every dollar that you sell, how much do you generate in net income? Also known as your profit margin ratio. And that is really the ability, it measures, gauges the level of ability to drive profitability out of every dollar of sales. And it looks at their ability to control their expenses and manage their costs so as to drive profitability from every dollar that they sell. And it's important to note that that really does vary by industry. Some industries, let's say biotech, they're not going to have profits, as they are oftentimes in a research and development mode, and they're using their capital to help build a drug. A manufacturer of equipment, which has a higher cost of building that equipment, is likely going to have a lower profit margin ratio than, a company that's selling software, which has a higher profitability associated with it. Your return on common stockholders' equity ratio is, of course, your net income of the organization divided by the invested capital. If you have sold $100,000 worth of stock, and for a period you had recorded $200,000 of net income, that would be, in this case, $200,000 of net income divided by your $100,000 of invested capital, and that would give you a return on common stockholders' equity ratio of 2 to 1. The higher that ratio is, the better, as it's a measure of the overall accomplishment that that organization is able to achieve based upon how much equity capital that they've raised. Of course, that equity capital is going to be the capital that's helping to grow and drive the business. And now by looking at how much net income you're able to achieve, you can see how effective the organization was in using that common stock that they sold to drive profits. There's examples of this in the book, which I'd encourage you to look at. And finally, your return on assets ratio is looking at your net income with invested capital as measured by your average total assets. And that's just looking at how effective you use your assets to help drive profitability. We're going to pause here. We're going to discuss a couple homework items in the next 15-minute interval, although this one is going to end a little bit short of 15, and then we're going to jump into the next chapter as well. Thanks.